post-Wednesday, I think markets are going to have some visibility, and that allows us to take some of the selling pressure off. So, yes, I think it's possible that instead of us breaking down here and seeing markets under further pressure, we're actually got the right pieces
buy,
for a
though,
bottom.
into this without knowing what's on the other side of it? That is the fundamental question that people are sitting around trying to figure out today and tomorrow.
That's right. It's an interminable wait for people because it is still 3 days, and they're fearful that we could have 3 days of down 2%. But I kind of agree with Larry Fink. I think the U.S. is going to come out of this okay. I mean,
market chaos before Trump's Liberation Day, yet Tom Lee says, buy the dip for a face ripper rally, but is he ignoring the warning signs? The shocking truth about what happens after April 2nd is coming up. Right, so the markets have been absolutely wild. The S&P and the Nasdaq both gapped down dramatically on Monday, only to claw back nearly half those losses by the closing bell. And while most investors are still holding their breath for Trump's tariff announcements today, Fundstrat's Tom Lee made an extraordinary claim. He's predicting a dramatic V-shaped recovery starting immediately after the tariff news drop. And for those short on time or who just suffer from general TikTok brain, here is the essence. That one's going to get decided this week too, the TikTok decision. We'll talk about that in a moment. But we're witnessing one of the fastest 10% market declines in history, with over 850 billion flowing into money market funds, safe havens, just since February. Tom Lee believes this creates the perfect setup for an explosive rebound, and I'll reveal the exact stocks he's targeting for 30% plus gains. So in the next few minutes, you'll know precisely which sector could soar and which might collapse after the tariff announcement. Now, I've spent years analyzing precisely these types of market dislocations, and I can tell you that what we're seeing now has some remarkable historic parallels, many of which actually support Lee's seemingly outlandish prediction. Have you noticed how quickly sentiment has shifted from new all-time highs to impending doom in just a couple of days? Take 10 seconds right now. Take a screenshot of today's market open. Seriously, do it, because you'll want to compare it to where the same stocks and indices are trading 1 week later after I explain Lee's recovery thesis here. And if you've been nervously watching your portfolio this week, checking in every few seconds to see if that makes a difference, take a moment and write down which of your positions you're most concerned about. In fact, put it in the comments down below so we can all see it. I think it'd be helpful for the community. And I'm going to cover exactly which stocks Tom Lee believes are primed for the strongest recoveries. And I want you to see if any of those match with what you're currently holding, hence the little exercise. Now, after studying Tom Lee's recovery predictions and the key indicators he's watching, I realized this analysis connects very well with something I've been developing for years. And for those of you who want to learn that and consistently spot these market inflection points before they happen, whether it's catching the breakouts before they happen or selling before the stocks collapse, I've distilled all of that into one little thing I'm going to give you. And maybe you're skeptical. Maybe you're thinking, oh, you're telling us about this after the fact. Nobody can predict. Let me tell you a little story about a girl called Catherine, who's a student of mine. And she wrote a little nice message today, which was saying, I've been a member since January. And by the way, everything I'm about to give you is completely free. And learning about stop losses saved my portfolio for sure. Even for the stocks that were in the red, the skills saved my portfolio another 10 to 20%. Some of these stocks have gone down another 30% since. I did what I didn't want to do and sold when the numbers hit the lowest red I was willing to go. And for some reason, we've been trained to just watch our stocks go down and down and down. And it goes against every instinct that I have, including the hold and buy the dip mentality we've all been taught. And she says, I'm so glad the coach is encouraging the group to be cautious and practice good risk management. And she's basically saying, I hated when these stocks got sold by our risk management. It's automated. But she says, looking back, I couldn't be more grateful. And you know what's going to happen to Catherine? When she buys back into those stocks, she'll have 20% more stocks than people who've held. She'll literally come out of this dip with 20% more stocks of the same tickers that she already owned, and she'll be wealthier for it. So if you want to learn this skill, which would save your portfolio and will also set you up for this cataclysmic recovery rally that will come. Go and watch the masterclass. That's how Catherine started to learn with us. felixfriends.org/getfree is where you get that. And that takes you literally 15 minutes. Why is it felixfriends.org/getfree? Because it's going to help you get free, just like it did for Catherine here. And I want that for you. Our mission is to make 1 million of you into Catherine's. So whether you're new to investing or you've been doing this for years, by the way, the framework I give you will give you this exact same process, and you're going to get tremendous value from it. How do I know that? Because literally thousands and thousands of you have told me that. Now, what's happening with Tom Lee? Why might he be right about the V-shaped recovery, and exactly which stocks does he believe will lead this rebound? Now, what's key about Lee's analysis is how he's tracking the money flows. According to his latest FundStrat presentation,
if you look at money market cash balances at the end of July of last year was 6.1 trillion, and they're currently 7 trillion. So even though the S&P's been roughly at the same level, money market cash has risen by roughly $850 billion.
Now, this is quite remarkable when you think about it. We've gone from 6.1 trillion in money market funds last July to approximately 7 trillion today. That's an enormous pile of cash sitting on the sidelines just waiting to be deployed. And by the way, most people thought it would go the other way. But let me ask you this. When was the last time you saw nearly $1 trillion move to the safety of cash in such a short period? And it's not just retail investors. Hedge funds have reduced their positions to levels we haven't seen since before the pandemic. Even margin debt, which is like, people use margin because they're really, really bullish, has come down significantly. According to Lee, if you've got some cash positions sitting there, you're not alone. In fact, I'm sitting on a lot of cash at the moment because we got stopped out of a lot of things. That's our risk management at work. Now, the second pillar of Lee's argument, and this is where it gets particularly compelling, one might say, is the speed of the correction. Lee states the 5th fastest 10% decline ever were actually shocks to the market, not the start of a major downturn. So what Lee is pointing to is quite significant. When markets drop this quickly, it's typically a panic reaction rather than a methodical sell-off based on deteriorating fundamentals. And historically, this is crucial, these types of rapid corrections have typically been followed by equally rapid recoveries. We're talking about the V-shaped bounces and not prolonged bear markets that grind lower and lower for months. Are you familiar, let me ask you this, with how markets behaved after the December 2018 trade-related corrections? Well, if you're not, it actually makes you normal. But to take a moment to recall how quickly stocks recovered once the initial panic subsided, and you might need to refer to a stock chart for that. Lee believes we're in a remarkably similar situation right now. Perhaps the most intriguing part of Lee's thesis revolves around what he calls the Trump put. In his own words, there is a Trump put, evident by what's happening with Tesla stock. In essence, Lee believes there is an implicit guarantee from the current administration to support key market drivers when necessary. It's similarly to what we used to call the Fed put during previous market cycles, but now with the added dimension that it comes from the White House instead. Now, what is a Fed put or a White House put? Is essentially saying they'll only tolerate markets going so low before they'll step in with some sort of positive statement, some sort of policy act, or some sort of intervention. And what's rather telling is how he points to Tesla as the perfect example. Despite being at the center of various controversies and facing headwinds from competition, Tesla stock has shown some remarkable resilience in recent days. Not recent weeks, if you go back a little bit, the stock's down 40% plus. But this bottoming out is something that Lee attributes directly to government support. And when you combine this implicit backing with the Federal Reserve increasingly dovish stance, Powell has practically telegraphed potential rate cuts later this year. We're now expecting probably 3. You get a powerful combination of policy support that could fuel the V-shaped recovery that Lee is predicting. So does that policy backstop, let me ask you this, make you feel differently about your portfolio right now? If it does, put it in the chat down below, right? Different, right? Now, because according to Lee, it should. Now, when we look at the broader historical context, there is actually quite a lot of evidence supporting Tom Lee's position, though I should point out there are some key differences this time around. If we go back to 2018, the beginning of that trade war that Trump kicked off, we saw remarkably similar market dynamics. The initial shock was brutal, major indices tumbling as uncertainty gripped investors. But what the research showed after analyzing that period was fascinating. Yes, the immediate reaction was severe, much like what we're experiencing now, but many sectors stabilized and investors recognized the discounted valuations. I remember analyzing this with Winston too, and what struck me was how quickly sentiment shifted once the initial panic subsided. Companies proved far more adaptable than markets initially gave them credit for. So if you go back to that time, did you panic sell, or did you use that opportunity to accumulate quality companies at lower prices? Well, one would have made you poorer and regretful, and one would have made you feel absolutely fantastic. If you wanted to be the latter, by the way, come and learn the rules, like hard written rules. There are only 3 of them you need to know, and they're in the masterclass that's down below at felixfriends.org/get-free. Now, the data suggests those who bought during those dips outperformed. Duh. Now, regarding the immediate situation, the news flow over the past 48 hours has been chaotic. According to CNBC's reporting just yesterday, Trump says reciprocal tariffs will start with all countries and rejects a narrower launch. And this is considerably more aggressive than many analysts had anticipated, with a 25% duty on auto imports being particularly significant for global trade. What's more concerning is the response we're already seeing from trading partners. Reuters, I know not exactly the most independent outlet out there, but we've got to deal with it. They reported that countries, including China and the EU, have either already imposed tariffs or are preparing countermeasures. And these retaliatory measures could create additional volatility in the short term, particularly for sectors with more complex global supply chains. But, and this is where Lee's thesis becomes particularly compelling, these known unknowns, silly statement, I know, but these are precisely what's driving money to the sidelines, creating that 850 billion cash pile. Just imagine how big that cash pile will be. That's fun, isn't it? Have you noticed how certain sectors are pricing in worst-case scenarios? Look at semiconductor stocks or luxury good companies with heavy foreign exposure. Many are trading as if trade will just stop, which is almost certainly an overreaction. So the question now is whether the clarity provided by tomorrow's announcement, regardless of how negative the actual policy might be, could ironically serve as the catalyst for Lee's predicted V-shaped recovery. Now, I wouldn't be doing my job properly if I didn't present the other side of the argument because, well, despite Tom's compelling case, there are serious risks to consider before jumping into the market head first. I'm thinking here of Scrooge McDuck jumping into his gold storage. Now, the first major concerns, and this has been something I've been wrestling with myself, is just how unpredictable these tariffs can be, and particularly our President Trump. We simply don't know exactly how deep or wide-ranging the impact will be. I'm not sure Trump knows himself. And Forbes recently put an analysis out showing that while markets eventually adapt to tariff regimes, the adjustment period was far longer and far more painful than investors had typically anticipated. And it's worth noting that what we saw in 2018 was primarily a bilateral trade dispute, US, China. The rest of the world was kind of fine. What we are potentially facing now is much broader, multilateral, like the US and everybody else. And then there is perhaps the economic scenario. This is something that you gotta factor in. MSN News, again, not entirely independent, but what news is these days, and I quote here, economists warn that the combination of slowing growth and persistent inflation, stagflation, could dampen the market's upside. And this news recently highlighted that economists are increasingly concerned about this toxic combination of slower growth and inflation. And the third counterpoint comes actually from the man himself, Tom Lee. While he's broadly bullish, he acknowledges that there are sector disparities. What Lee's admitting here is that the recovery won't be uniform. Sectors like consulting, Accenture being an example here, have already experienced deeper declines because of their government contracts being doged. Similarly, companies heavily dependent on international revenue could face pressure if retaliatory tariffs come in. Auto manufacturers are another vulnerable sector there. Companies like GM and Ford, despite being American, could suffer because their supply chain and their manufacturing typically isn't all that American. And then for us retail investors, there's simply the question of timing. Even if Lee is ultimately correct about a V-shaped recovery, the journey there could be extraordinarily volatile. And I've learned this lesson the hard way. Over the last 10 plus years as an investor, markets rarely move in straight lines. And that's why we have exact rules when we buy, rather than just like what feels like we should be buying or listening to some guy on CNBC, no matter how smart he might be. Because market psychology is ultimately what drives this. And there are hard measures for that. And again, I'll explain that to you in the masterclass, so this video doesn't get another 20 minutes longer, and you can replay it as many times as you like. And those of you who already have will already understand what I'm talking about. But again, link is down below, first one in the description. What's the conclusion here before we look at the actual stocks that he's saying we should buy here? I think the key is selective positioning and timing. So not being too early. In fact, we always want to be just a little bit late. And I know that's a hard concept to understand, but it's better to be a little bit late and be on the rally than a little bit too early and then, experience the knockdown, because people typically sell when we go too low. So you got to pick your spots. And again, there are rules for that. Very, very simple. There are only 3 you need to learn, and they're in the masterclass down below. Now, a simple solution to this might be a gradual investment staging. So you buy a little bit every week rather than putting it all in, in there on one. And does that in the long run make a huge difference? No, but it makes you sleep better at night. It makes you feel better, because if it goes down a bit lower, you think, well, I'm going to buy a little bit lower again. So it kind of just averages you out. It makes you feel a little bit better. And that's one thing I often tell my students to do, is just spread it out over time. It just makes it a little bit easier to digest. As for those opportunities, those specific key stocks that Tom is highlighting, now there are in different sectors. In energy and cybersecurity, Lee believes that GE Vernova and Palantir are particularly well positioned to weather trade tensions and potentially benefit from increased domestic priorities. And I can see the logic of it. For quality growth companies, he specifically mentioned Cadence Design, a stock we covered many times last year, Netflix, as having the balance sheet and strength and business model resilience to thrive even if the market gets a bit, topsy-turvy. And then for manufacturing recovery plays, these are stocks that are typically outperform when manufacturing activity rebounds. He's highlighting not actually manufacturing plays, but JP Morgan, Bank of New York, and PayPal as his top picks. And perhaps most importantly, Lee views Tesla as the key bellwether for this entire recovery thesis. After falling about 50% from December, he believes a recovery above 330 would be the confirmation signal that a V-shaped bounce is genuinely underway for the market. Right now, if you look at the stock chart here, we're trading at 268. 330 would be about here, about $30 above the current resistance line, which is where Wall Street's finest, the market makers, sell Tesla when we get there. Now, let's actually take a look at the current charts for these, and we'll get a little bit more clarity. So we start off here with Tesla, as we're already there. So I'm going to open up the 200-day moving average line for all of these stocks and tell you for which stocks we're below it. Now, it's that sort of red line I'm drawing in here, there. That's the 200-day moving average line. We're below that. And there is a very, very good thing that's been around for a very long time from a very, very successful investor called Paul Tudor Jones. And he said, nothing good happens below the 200-day moving average line. And I think he's right on that one. So it would take a real hardcore Tesla believer with a very long horizon and who doesn't care if things go down 50% to be buying at these levels. By the way, the point to sell was up here, and we actually even gave you a bearish flag symbol there inside Trade Vision, which you can get access to for completely nada, nichts, for free as a trial. If you go to felixprehn.org/tradevision, it's a tool we built to give you better data. So from the top, the next stock he mentioned is GE Vernova. Energy play, energy infrastructure play. Now you will note that this one is actually above its 200-day moving average line. Here it hit it and it bounced off it in a V-like shape. And that was a very positive sign. It means there was some real support here. Now the only slight fly in the GE Vernova ointment is that we hit pretty much exactly the previous high, and then we bounced off that one too and came back down. Let me just see if that corresponds with any higher average line. And look, it does precisely. Bounced off the yellow 50-day moving average line there, which is sort of a bit of a party pooper, really. So it's not as bad as Tesla, but it did not make it through that yellow 50-day moving average line, but it's also now sloping down. And if you've watched my masterclass, you'll understand exactly what that means. So also what I would point out, this recovery here happened on pretty boring low volume, which is rarely a good thing. Whereas the sell-off was happening on very, very much higher volume. So be a little bit careful and cautious there. I'd wait for the entry signal, which you learn if you watch the masterclass down below for free. Now, good old Palantir has had, again, a decent run. Again, we gave you a nice bearish exit signal up here, which I think was a good call at about $105. And you would now be looking at, well, you'd be about 20% better off. And therefore, if you were to buy back in here, you would own 20% more shares in Palantir for absolutely nichts. That's absolutely better than buy and hold, wouldn't you say? So what's the problem with this right now? Well, the problem is ultimately, if you zoom in a little bit here, make this a bit bigger, that we're still below that yellow 50-day moving average line. That's kind of the problem. But we're only a little bit below it, and it is still moving up, which is a positive. So again, I'd wait for the classic buy signal there that I teach you in the masterclass, and then you know what to do. Now, next is good old Netflix. I suppose the theory being there, if the economy goes to shit, people will just sit at home, eat pizza, get drunk, and watch Netflix, which is not really reassuring, is it? So good news here is we are pretty close to the 50-day moving average line. That's the 50. We are very, very, very far above the 200-day moving average line. And that's, again, why he's picked this, right? Everybody on Wall Street follows broadly the same rules. We all look at broadly the same data, which is also why it works, because everyone's looking at more or less the same thing, those in the know at least. JP Morgan, the bankers of the poor and orphans and widows, and very, very charitable organization, similar situation, right? So we bounced off the 200-day moving average line here, that brown line there, that was the 200. And then we didn't quite make it to the 50. Why? Because there was that resistance, and it meant Wall Street had to sell JP Morgan at 255, and sell they did. It's nice and predictable if you had the indicator. And we're kind of trying to figure that out right now. So problem for me is one high, second high is lower, third high is lower yet. So the real question is, where is the fourth high going to be? It needs to go above the third high to have any chance of a real recovery. But I do agree that financials should do rather well. Now, Bank of New York will be rather similar, so we're going to skip that one and we're going to look at PayPal instead. And what do you see with PayPal? Well, classic setup. Nice, beautiful breakout move here. Really, really, really nice. And then there was a classic telltale exit sign here that obviously most people missed. Again, I'll teach you that if you watch the masterclass. And you would have locked in a very nice profit, and you would be very, very happy, rather than most people are now in pain. The problem with PayPal is we are way below this 200-day moving average line here. Way below it. We're really, really kind of trying to make lower lows here. And the moving average line, the yellow one here, I know I'm drawing them all in yellow, but you get the idea, is falling like a knife. So this is not the moment to buy PayPal, in my opinion. I think PayPal will have a beautiful, shiny recovery. And if it does, I will be buying it hand over fist. But right now, I'm doing absolutely nothing with PayPal, because the chart says to you, this is bad. And if you thought it couldn't get any worse, well, you might want to ring up one of the people who owned PayPal at 300 and then saw it go down a staggering 80%. Actually, a little bit more than that even. It went down 87%, so maybe I'd make that out from the top. So if you think things can't get cheaper and that it's a brilliant value at this price, well, I'm sorry to say you're going to lose a lot of money, and you're going to really get really, really frustrated, and you're going to scream manipulation and murder at the market, which is possibly all accurate, but it isn't going to make you any money. It's not going to make you feel any better. And my goal here is to help you make money despite the unfair setup. And that we can. And that's how we wrap up this video. I thank you for watching. If you got some value out of this, go and watch the free masterclass at felixprehn.org/get free, because imagine how much value you're going to get out of a purely educational video rather than a sort of market news roundup. All the best. Wall Street is in freefall as Trump's Liberation Day approaches, with the Nasdaq plunging over 2.5%, consumer confidence hitting 4-year lows, although that data is a little dodgy, admittedly,